comes to investing in the stock market, there are typically two strategies that people follow. One is technical analysis, and that is used more for short-term trading, day trading, and swing trading. And then fundamental stock analysis is used more for investing, long-term investing. So when people are trading stocks, they're looking for stocks that have volatility. They're looking to track the price movements, look at things like volume and different technical indicators like simple moving averages. And if you guys want to learn more about technical stock analysis, what I might do is bring on an expert who can teach you about this right here in the group. So if you guys want to learn more about that, drop me a comment there over on the Stock Radar membership group, and I will definitely do my best to get that to you guys. But the reason why people use fundamental stock analysis is a way for them to determine the actual underlying value of an asset. So basically, this is what I look at. Fundamental stock analysis is used to determine the financial health of a company. Is this company in good financial health? Do they have good coverage of their debt? Are they generating a lot of free cash flow? Or is this company in poor financial health where they're burdened with debt? They have more debt than they do have assets, and maybe they're losing money or they're not making much money at all. It's a way to determine the financial health of this company. Now, technical stock analysis, on the other hand, is used to look at the price history and other data like volume and different numbers to determine the price movements in the short term. So fundamental stock analysis is used to determine where is this company heading in the long term? Are they going to good places or are they going to bad places based on the financial health? While technical stock analysis is used to determine in the short term, what is that price likely going to do? Looking at things like support and resistance areas and all kinds of different indicators. So traders use technical stock analysis to determine the optimal buy points for stocks, and they're looking to do swing trades or day trades and make many small gains over a short period of time. Where long-term investors are looking to invest in a company, hold it for many years, and see that appreciate in value. So people who are trading use technical analysis to determine when is the best time to get into a position, and people who use fundamental stock analysis are looking to invest for the long term and invest in a company with very good financial health. Fundamental stock analysis tells you the health of the company, and then technical stock analysis tells you the personality. Is this a durable investment that doesn't have much volatility, or is this a tech investment or a biotech investment that is very volatile? It's kind of like the personality of that investment. And people who are looking to trade on small price moves within the week, that is what you're using. You're using technical stock analysis. And people who are looking to invest in the long term are going to rely on fundamental analysis. Now, you could use technical stock analysis to find the optimal entry point by looking at support and resistance areas, but you really don't have to do that. So, but if you do want to be a successful long-term investor, you really do need to understand some of the basics of fundamental analysis in order to understand whether or not something is overvalued or undervalued. You can do fundamental stock analysis. You can look at the things that we do here on Stock Radar, like the pros and cons, the moat for this company, the barriers to entry, and then looking at the actual fundamentals, the key financial documents like the balance sheet, the income statement, and the cash flow statement. You look at all of these things and you determine the overall health of this company. So your goal when performing fundamental stock analysis is to determine the underlying value of the asset. A lot of people get confused. They look at the price of something and they say, okay, that price must tell me what the actual value is. And in the next section, we're going to talk about price versus value and how these are two entirely different things. And I'm going to give you an example down below of how the share price has nothing to do with whether or not a stock is expensive or cheap. But this is the basic strategy of fundamental stock analysis. You take a look at the fundamentals of the company, you determine the financial health of this company, and some people decide to bet on a strong company. They're looking to buy low and then sell at a higher price in the future. Or some people are actually looking for very poor companies as far as very poor financial health that are burdened with debt and likely to fall in the long term. And they're actually going to bet against weak companies by short selling them. I'm assuming most of you guys are looking to bet on good companies, not betting against bad companies. And I don't personally get involved with short selling, so that's not really anything I'm going to discuss. But that's pretty much what people are doing. They determine the financial health, and they either bet on good companies or bet against the bad ones. But now I want to show you guys how the share price has nothing to do with whether or not a stock is cheap or expensive, and it's a very simple example here. So let's say company A has a market capitalization of $100,000, and the market cap is very simple. That is essentially the total value of all of the outstanding shares. So now let's say they have 1,000 outstanding shares available to both the public and the private, which means that they have a share price of $100 per share. Now let's take a look at company B. Company B has a $100,000 market capitalization as well, but instead of having 1,000 outstanding shares, they only have 100. And as a result, this stock is $1,000 a share. Now, somebody who doesn't understand how to perform fundamental stock analysis might just take a look at this stock and go, okay, $100 a share, that's cheap. $1,000 a share, that's expensive. And that is why a lot of people fall into the trap of buying into penny stocks or stocks with a very low price per share because they think they're getting more bang for their buck. They look at a stock like Amazon that's trading around $1,500 a share as of making this video, and they look at a penny stock that's trading for 15 cents a share, and they go, wow, I can get a lot more shares of this penny stock than I would of Amazon, and they think they are getting more of a bang for their buck. But the truth is, guys, as you can see here, it all depends on how many outstanding shares they have of that company. Amazon has made the decision not to split up their shares through a stock split, and they prefer to have a higher share price. And it has nothing to do with the actual piece of ownership you're getting of that company, because it depends on how many shares there are out there. So the main takeaways from this, guys, are that fundamental stock analysis is going to show you the health of this company, while technical stock analysis shows you the personality. Most long-term investors are going to focus solely on fundamental analysis, and traders and short-term investors are only going to focus on technical stock analysis. They don't really care about the financial health of the company. They just care about the personality of that stock and the short-term price movements. And to be a successful long-term investor, you do need to understand fundamental stock analysis, but it is not important to understand technical analysis. It's just another tool in your toolbox if you want to use it, but you certainly don't have to have that as something that you are relying on. And people are going to bet on strong companies and bet against weak companies through performing fundamental analysis. And again, the share price has absolutely nothing to do with whether a stock is expensive or cheap. Fundamental investors understand that the price of an actual stock and the value of that piece of ownership are two entirely different things. And those who don't understand fundamental stock analysis believe that the price actually determines the value. And what you need to begin to understand is that these are entirely different things and they operate in different ways. So once you understand that the actual price of something is not always equal to the underlying value, that is where you can begin to unearth some opportunities as a fundamental investor. So your goal through fundamental stock analysis, as we said before, is to determine the overall financial health of a company. And the reason you are doing this is because you want to get an idea of the underlying value of that piece of ownership of a company. Remember that when you're investing in stocks, this is actually an ownership interest in a real company, and you own a piece of that company. And you want to understand, what is this piece of ownership actually worth relative to the market price? So first of all, let's go ahead and talk about price. Price is very simply what you would expect to pay for something. So if you went to the store right now and went to buy laundry detergent, you would have an idea of what the actual price would be that you would pay for that. Now, if you went to a store and all of a sudden laundry detergent was $50 a jug, you would say, this price is well above the value of this laundry detergent. There's no way I'm going to be buying that. On the other side of the coin, if you went to the store and you saw that laundry detergent was $1 a jug, you would say, wow, this is a great value. I know what this laundry detergent is actually worth. The price is well below the value, so I'm going to buy 5 or 10 jugs and stock up. This is exactly what people do when they're investing. And when they're looking at a stock and they see that the actual price is well above the value, they say, that's not something I want to touch. That stock is trading on a speculative level, and the actual market price is well above the underlying value.
Since 1998, OnlineLabels.com has been providing premium labeling solutions for businesses, entrepreneurs, and crafters. Whether you're in the market for blank label sheets, rolls, or custom printed labels, we can help. Start saving today with OnlineLabels.com.
This is how Fiverr changed my life. My name is Drew, and I'm the face and hands behind the Lone Fox YouTube channel. I started my first channel when I was 16, and I was able to teach myself how to edit on Windows Movie Maker and create mediocre graphics in Photoshop. I always had a vision for my brand, but without the proper skill set, it could be hard to achieve on your own, until about 2 years ago when I found Fiverr. From my logo, exclusive merch collection, blog, an e-commerce website, I found the help I needed to turn my vision into a reality. Search the site for the project you're looking for, and find freelancers from around the world that fit your budget and project needs. Each freelancer provides a sample of their work, and you can also read reviews from past projects that they've worked on. Share your project ideas, and you're good to go. Creating your online presence doesn't have to be time-consuming, hard, or expensive. I wanted to make it easier for you, so I curated a store with Fiverr that showcases some of my favorite freelancers from around the world. Now, nothing should be holding you back. Click the link on the screen to get started.
Now, on the other hand, when they see something that is trading at a price well below the value, they say, okay, this is on sale. It's just like having laundry detergent be on sale at the grocery store. And they say, okay, I better stock up on this. I better buy some shares of this company. That is what you're looking to do with fundamental stock analysis, is determine whether or not an asset is overvalued or undervalued. Now, as I'm sure you know, when you look at a stock online and you look at the price chart during a trading day, the price goes up and down throughout the day. And I want to ask you a question. Do you think the actual underlying value of that company or of that stock is changing every couple of seconds, just like the price is? The answer is no. The actual value of something changes in the long term, while the market price, or the price people are willing to pay at a set point in time, changes in the short term. And once there is a deviation between the market price and the value, that is where there is a potential opportunity. So let's go ahead and look at these three examples here, okay? So the green line represents the actual value of something, and the red line represents the market price. So on the left here, this is an example of something that is undervalued. The actual value is well above the market price, and if this was a stock, this could be a buying opportunity because you could buy in for less than the actual assets are worth. Now, on the other hand, let's look at something that is actually overvalued, and that would happen when the market price is above the underlying value of that asset. So if you were a fundamental investor and you were looking at these two examples, on the left would be one where you would be interested in buying because the actual value exceeds the market price. Now, if you were looking to bet against a company and you performed your fundamental analysis and you found a company in poor financial health and you found that the actual market price was trading above the value, that might be something where you decide to short or bet against that asset. Now, this on the bottom left here is what most people see. They don't think there's any difference between the price of something and the value of something. They think that the price determines the value, and that is just not the case. Again, these are the same people that look at a stock and determine if it's cheap or expensive by looking at the share price. And we already dispelled that myth in the last video. So understand, this is what most people see. They see the price equal to the value, but there is deviation between market price and underlying value taking place every single day. Now, why does this happen? This happens due to supply and demand. Supply and demand is going to create price and value deviation. So supply is a result of people being fearful. They're afraid of holding this particular asset, and so they sell it. And when the overall sentiment around that asset is fearful, it's going to go into a sell-off, and that may result in a buying opportunity for investors. Now, on the other hand, when people are greedy, they're going to be buying assets. They're going to be buying shares of that stock left and right, and that may result in that stock becoming overvalued. That is where a couple of these quotes come from. For example, buy from the pessimists and sell to the optimists. You want to buy when people are fearful and then sell to them when they are greedy. Or the famous quote from Warren Buffett, be greedy when others are fearful and fearful when others are greedy. You are looking to buy stocks when they are undervalued and then sell them when they are overvalued. So the main takeaway for this video here is that the market price is going to change in the short term. Every couple of seconds, what people are willing to buy or sell that stock for is going to change based on supply and demand or the market fear or greed. But the actual underlying value changes in the long term. The value of Amazon is not going to change every couple of seconds, but the market price of those shares is going to. And what you are looking to do is find an opportunity where you see the market price is well below the underlying value. That is an investment that is undervalued, and that is when you would want to buy. But when it comes to fundamental stock analysis, you have to look at many different things to get an idea of the overall landscape of that investment, and you can't rely on any one indicator. A lot of people make the mistake of solely looking at the PE ratio when determining whether or not a stock is expensive or cheap, and you just can't do that. You just can't rely on one indicator. And in the next video, we're going to talk about the PEG ratio as well as the forward PE, and we're going to explain where the PE ratio falls short. But let's go ahead and talk about the price to earnings ratio in this video here. So the way you calculate the PE ratio is very simple. You're going to take the market price per share and divide it by the annual earnings per share. And typically they're looking at TTM, or the 12 trailing months. So the earnings per share over the last 12 months of the quarterly earnings reports. And that's going to give you an idea of the earnings per share. So Apple stock, as of making this, had a market price of $177.66. And in the trailing 12 months, they have had $9.70 of earnings. So you take that $177.66, divide it by 970, and this comes out to a PE ratio of 18.3. Now, for those of you that do not want to be sitting down and doing math on paper or on your computer, the good news is this is calculated for you, but it's very important to understand where these numbers are coming from when you're doing fundamental analysis. It's important to understand the actual theory behind this and where you calculate the PE ratio. Now, what's also important to note is that you can use the PE ratio as a comparison tool, but you can't compare companies from one industry or sector to another because every single sector or industry out there has a different level of normality or what is normal. So just for an example of this, let's take a look at this here. The construction materials industry has an average PE of 22, and that's a 2018 estimate, while the semiconductors industry has a price to earnings ratio of 80, and that's again a 2018 estimate. So you could not compare a construction materials stock to a semiconductor stock because the levels of normality are almost 4 times the difference here. It's almost 4 times more expensive for a semiconductor stock, and that is primarily due to the fact that the projected growth for the semiconductors industry is significantly higher than the projected growth for the construction materials industry. But let's take a step back and talk about what this PE ratio actually means. So we said Apple has a PE of 18.3, but what does that actually mean? That means that Apple stock is trading at an earnings multiple of 18.3, or as an investor, you would expect to pay $18.32 for exposure to $1 of company earnings. So if a stock had a PE of 80, for example, the semiconductors industry, you're paying $80 today for $1 of company earnings per year.
Good morning. Peace, power, and profit, everybody. I'm going to show you. You can go to FinViz.
Hello, Monica.
Hey, peace, power, and profit. Who I got with me? I didn't even pay attention. Oh,
Jermaine.
hey, May. I'm over here trying to get me some fundamental analysis training.
It's all good. I'm tapped in. Just rising.
Yep. Just trying to get the knowledge up.
Market look red today, though.
I know. You think it's still in the bearish trend? Yeah, yesterday was wild, man. This SPY went crazy. I know you made big money.
No, I was working. I took on a couple of I took on an instructor job, so I was working all day yesterday.
Look, Sonny called it right on the money, man. He was like, "Oh, SPY getting ready to go to 382 because Apple is in the up. You know, Apple is going to the upside right now." And I kid you not, that bad boy, that market opened and it just soared. I was like,
wow.
We was analyzing the chart, you know, that morning, and oh my goodness, like it was crazy. But anyways, so this is the PE, you guys. So if you went to FinViz, this is where you can find the PE that he's speaking of right now. So you can put in any company, so you can follow along the fundamental analysis. And this is what he's talking about. All right, so let's get back to it. He's talking a little fast, so you know I'm trying to keep notes at the same time. But he's a fast talker.
So that shows you how stocks become overvalued or undervalued looking at the price to earnings ratio, and certain industries become priced in at a higher price today due to the fact that there is greater potential growth expected. Now, we're going to talk about that more in the next video when we go into the PEG ratio, but just understand that when there is more anticipated growth for an industry or a particular stock, you're going to see that PE ratio climb. So when you're looking at stocks out there, you're going to typically see a higher PE ratio with growth stocks because they're going to grow more in the future. And income stocks are going to have a lower PE ratio because there is less anticipated growth expected. So now that we know what the PE ratio actually is, how do we use this tool for comparison? So number one, you can compare the PE ratio of a company to the industry average. And I recommend using the Fidelity Sectors and Industries tool. It's very helpful for getting industry data and average PE ratios as well as industry growth statistics. So you can compare it to the industry average or compare it to the competition. So for example, here we have JP Morgan stock has a PE ratio of 18.4, while Bank of America stock has a PE ratio of 17.7. So looking at those figures right there, based on the price to earnings ratio, JP Morgan stock is a little bit more expensive than Bank of America stock. Now, the other way you can use the PE ratio is to compare the price of this stock to the overall market average. So we know that Apple's PE ratio is 18.3, but the average PE ratio of the S&P 500 is a 25.7. So in relation to the overall market, we can see that Apple stock is significantly cheaper.
Do you own your home in South Carolina, but still?
So that is basically how you use the PE ratio. It is a comparison tool between the market as a whole and that stock, or stocks within the same industry, or comparing this stock to that industry or sector average. We're going to talk about two ratios that I find to be more useful than the PE ratio, and those are the PEG ratio as well as the forward PE. So we already talked about how the PE ratio is a useful comparison tool when comparing stocks within the same industry, or if you're looking at the price of that stock compared to the overall market. But now I'm going to point out the major flaw of the price to earnings ratio and the main reason why you cannot rely solely on this financial ratio. That is the fact that the PE ratio does not calculate any anticipated growth into that number. So let me go ahead and show you guys an example of this. Let's say tech company A has a PE ratio of 25, but they have an anticipated growth rate of 5% per year, while tech company B has a PE ratio of 75, but they have an anticipated growth rate of 20%. So if you're looking at just the PE ratio, we would say, okay, tech company B is a lot more expensive than tech company A. But when you actually consider the fact that tech company B is going to grow a lot faster than tech company A, you have to ask yourself, how would I even compare these figures? That is where the PEG ratio comes in. And this is a much more useful tool, in my opinion, than the PE ratio alone. So the way you calculate this is very simple. You take the PE ratio, which we learned how to calculate in the last video, and you divide it by the anticipated 5-year growth of earnings of that company. And that's going to give you an idea of the price to earnings ratio with the growth factored in, and whether or not that stock is overpriced, fairly valued, or undervalued based on that anticipated growth. So what are you looking for as far as the PEG goes? First of all, a PEG of under 1 is going to tell you that that stock is probably undervalued. And a PEG of 1 means that that stock is fairly valued, while a PEG over 1 means that that stock is overvalued. Now, I'm just going to warn you guys right now, especially during a bull market, you're never going to find a stock with a PEG of under 1. Otherwise, there has to be something very wrong with that stock. It's going to be very hard to find low PEG stocks during a bull market because lots of stocks are overvalued, and the market in general does become overvalued. This is a more useful tool during a bear market because you can unearth potential opportunities and look at PEG ratios and find low PEG stocks. So I want to give you guys two examples of this, okay? First of all, we have Qualcomm. Qualcomm has a PEG ratio of 1.22. So looking at this here, because it has a PEG of over 1, the stock is considered to be overvalued. But if you compare it to the PEG ratio of NVIDIA, which is 4.06, you can see that the PEG ratio is much higher for NVIDIA. So if you were to compare the price to earnings ratio with growth factored in of NVIDIA and Qualcomm, you can see here that NVIDIA is significantly more overvalued than Qualcomm. So this is how you would use this tool. You would pick two stocks that are in similar areas of operations, and you would compare the PEG ratio of these stocks and determine how much of that growth is actually priced in today. And that is how stocks begin to trade on a speculative basis, is when all of that growth or all of that future anticipated growth begins to be priced in today. And that is where a stock begins to be priced for perfection, where everything that is expected to happen to that stock gets priced in today. And if they have one hiccup during that operation, then the stock may fall significantly because all of that future growth or anticipated growth was priced into today's number. So what you're trying to figure out when looking at the PEG ratio is how much of that anticipated growth is priced in today. And again, guys, I just want to remind you, you do not have to calculate the PE ratio or the PEG ratio yourself or the forward PE, which we're going to cover next. All of these numbers are calculated for you. I always use Yahoo Finance. So you don't have to sit down and do the numbers yourself, but it's very important to understand where these numbers are actually coming from. So moving on now, let's talk about the forward PE, which is also a useful tool for.
So let me show you guys on Yahoo Finance. You can add in the ticker. Yahoo Finance have a live stream. It starts at 9 as well. You can stroll down right here. Let me get this off the screen. And you can see all of these all these numbers that he's speaking about. You can go here and you can begin to see all of the numbers and all of the data. The fundamental analysis.
Comparison. The forward PE takes the current market price per share and divides it by the predicted earnings per share from analyst expectations. Now, the one thing we have to point out here is all of this here, the PEG and the forward PE is based on expectations. And as we know, oftentimes expectations are not a reality. So you have to always consider the fact that this is not a guarantee. These are Wall Street estimates. At the end of the day, it's an analyst's best guess as far as where earnings per share will come in and how fast that company will grow. So always understand that the earnings expectations are not always going to be a reality. So these are all based on predicted numbers. And again, the way you use the forward PE ratio is to determine how much of that future growth is priced in today. Or if a stock appears to be overvalued today with a sky-high PE ratio, it might be because the forward PE ratio is expected to be much lower. Now, we're going to use Amazon as an example, and their PE ratio is 247, while their forward PE ratio based on predicted earnings per share is at 99. Both of these are very high. As we know, Amazon is a stock that is probably overvalued, but they are a stock that is executing with perfection on all fronts. So a lot of people have high hopes for Amazon, and a lot of that has been priced into the share price today. But Amazon is a stock that is absolutely dominating, so it makes sense for them to have this high of a valuation. Now, many investors would not be comfortable investing in a stock with a PE ratio of 247 and a forward PE of 99. Remember from our earlier discussion, that means that currently you pay $247 for exposure to $1 of earnings from Amazon. And in the future, you would expect to pay $99 for $1 of Amazon's earnings. So you use this as a comparison tool between different sectors and industries to compare the PEG and the forward PE of competitors to determine whether or not a stock is overvalued, fairly valued, or undervalued. But by far, one of my favorite tools for analysis is looking at this PEG ratio. And it's very helpful to tell whether or not all of that anticipated growth is priced into today's number. In this video, we're going to be talking about the dividend. Now, I want to start off by pointing out the typical growth rate of a company, and it looks very similar to this curve here. So when a company starts out and when they're a new company, they're going to grow at a much faster rate than they're going to grow in the future. And as a result, you're going to see that growth begin to taper off going forward. So this is what companies do when they're in this zone here, when they're growing at a much slower rate, or they're just consistent with their operations. What they do is they pay dividends as a way to reward shareholders and keep them around. Now, dividends are quarterly cash payments, and they're sharing their earnings with the shareholders. So if they're earning a lot of money, they have a lot of earnings per share, they might make the decision to pay shareholders a quarterly dividend. Now, we talk about the dividend quite a bit here in Stock Radar. We talk about the dividend history, how long this company has been paying that dividend, the dividend growth streak, so how many years has that dividend been growing. And we also talk about the dividend yield, or how much they are paying to shareholders. So just understand that when a company is in income mode, when a lot of the growth has already happened and they're growing at a much slower rate, or they just have consistent or flat growth, they're going to become an income investment because they are likely going to reward shareholders with dividends. But a company that is in growth mode, if they're trying to grow as fast as possible, they're not going to pay dividends. They're going to be reinvesting those earnings into the growth of the company. So we used AT&T as an example of an income investment. They pay dividends to shareholders because they are not growing very fast. And Amazon is a growth stock because they are reinvesting all of the earnings to grow the company as fast as possible. And as a result, they don't pay a dividend. So Amazon is still down here on this curve where they're growing very rapidly, while AT&T is further along in this curve where they're pretty much flat with very little growth going on. And as a result, AT&T is paying dividends to reward shareholders and give them a reason to stick around. Because if you guys saw that video here on Stock Radar, the stock has had very lackluster performance, and there's not much there being offered other than that very high dividend. So how do you actually calculate the dividend that the company pays? What you do is you take the annual dividends paid out divided by the market price, and that's going to give you the dividend yield. And again, all you have to do is do a search for a stock on Google, and it's going to show you the dividend yield right on that chart. But that's how you go about calculating it. So let's calculate the...
One of our goals is to make the transaction as easy as possible.
AT&T. Over the last 4 quarters, they've paid a 49-cent dividend. So we take 49 cents times 4 and divide it by the market price of $37.16, and that gives us a dividend yield of 5.3%. So what kind of dividend yield should you be looking for as an investor if you're looking for an income investment? Well, the S&P 500 average dividend is around 2.2%. But if you're looking for an income investment and you're not focused on growth, a good number to look for is between 3 to 6. So AT&T falls in there. They have a 5.3, a very good dividend, but they have no growth potential pretty much. I mean, the growth has been non-existent over the last 5 years. So that's the issue that you have there. You have to weigh the pros and cons. Are you looking for a high dividend with low growth or no dividend with higher growth? That's what you have to decide as an investor, is what you are looking for. Now, another very important thing to consider is whether or not a company can afford to pay a dividend, because high dividends are great, but understand that dividends are not guaranteed and they can cut or discontinue a dividend at any time. A perfect example of this is General Electric. They had to slash that dividend because they simply could not afford to pay that dividend, and they still can't afford to pay the dividend even now. So the future for them is uncertain. They may have to cut the dividend again. But anyways, the way you calculate that is by looking at the dividend coverage ratio. And this is very simple to figure out. And this might be something you have to calculate on your own, because I have yet to find a resource that does this for you. But all you do is you take the annual earnings per share and divide it by the annual dividend per share. And that gives you an idea of how much of the earnings they are passing along to shareholders and how much of the earnings they are keeping for themselves. So basically, let's go ahead and calculate this for AT&T, looking at the fiscal 2017 year numbers. So for fiscal year 2017, AT&T had earnings of $4.76, and they paid out $1.97 of dividends, giving them a dividend coverage ratio of 2.4. So what exactly does that mean? Here's what it means. If the dividend coverage ratio is below 1, that means they are paying out more in dividends than they are earning. That was the case with General Electric, and as a result, that is very bad. That means they are likely going to have to restructure or cut that dividend. Now, if the dividend coverage ratio is between a 1 to a 1.5, they don't have great coverage of that dividend, and they will likely be cutting it or restructuring it in the future. The optimal zone to be in is between a 2 and a 3. And as we can see, AT&T came in at a 2.4, so they're right where they need to be. So when you're looking for a dividend coverage ratio, I always look for a dividend coverage ratio between 2 and 3. But on the other side of the coin, if the dividend coverage ratio is above 3, that means the company is retaining most of those earnings and they may be being greedy. So what I look for is a dividend coverage ratio between 2 and 3. If it's below 1.5, I don't think that is investment worthy. And if it's above 3, then you want to make sure that company is reinvesting earnings and not just retaining them for themselves. We just wrapped up talking about the dividend, and I want to show you guys one of the most common mistakes that I see people make when it comes to investing in dividend stocks. A lot of people start their search out by searching for high dividend yield stocks. And if you do so, you can find a nice list of stocks that pay very hefty dividends, but you have to calculate the dividend coverage ratio to determine whether or not a company can actually afford to pay that high dividend. So I'm going to show you guys an example of this here, a high dividend trap, a company called Spark Energy Inc., and they trade under the symbol SPKE. So on the surface here, we can see that Spark Energy has a PE ratio of 11.8. That's a pretty low PE. And they have a dividend yield of 7.6%. That's a very high dividend. As we said, the market average is around 2.2%, and a good dividend is between 3 and 6%. So a 7.6% must be a fantastic dividend, right? The answer is absolutely not, and I'm going to show you guys why that is. So now, because you know how to perform fundamental analysis of the dividend and calculate the coverage ratio, we can take a look under the hood. So the coverage ratio, again, we're going to calculate here by looking at the 2017 earnings per share divided by the 2017 dividends per share. So in 2017, Spark Energy Inc. had earnings of 27 cents per share, and they paid 72.5 cents per share in dividends. So that coverage ratio comes out to a 0.37. But what does that actually mean? What that actually means is that in 2017, Spark Energy Inc. had earnings of $3.5 million, and they paid $9.5 million in dividends. So they had a deficit in 2017 of $6 million just from that dividend. Let me ask you guys a question. Does that make financial sense to you? If you were making 25 cents and you paid someone 75 cents, you're going to have a deficit. That is what is happening here with Spark Energy Inc. And I can guarantee you that they're going to cut this dividend. They have no choice but to cut that dividend because they cannot afford to pay it. This is what you have to do. Anytime you're investing in a high dividend stock, take a look under the hood, calculate the dividend coverage ratio, and make sure the company can actually afford to pay that dividend, because Spark Energy can very clearly not afford to pay this. This is the high dividend trap that people fall into all the time. I've never done it myself because I understood this very simple concept of the coverage ratio, and now you guys do as well, and I hope you never fall into the trap of buying into a stock with a very high dividend, always take a look at the coverage ratio. We are now going to start talking about the key financial documents, which are the income statement, the cash flow statement, and then the balance sheet. Now, this is the part of fundamental stock analysis where a lot of people go, oh my gosh, I don't understand any of this and I'm never going to understand it, because if you go online and you start looking at a balance sheet or an income statement or a cash flow statement and you've never looked at these things before, you're going to be overwhelmed by the massive amount of information available to you. And it's very easy to just say, oh my gosh, I'm not going to ever understand this. I'm going to give up. And I want to encourage you guys not to do this. I'm going to try to make it as simple as possible and show you guys what things I'm looking for. But understand this is something you build upon with time. You learn a little bit each week, and over time you learn how to interpret these financial documents. It certainly does not come overnight. It took me months to really understand how to interpret these documents. But this should provide a basic understanding for you. And hopefully, as I go through these during Stock Radar and I'm doing actual analysis of these financial documents, you'll start to grasp what it is that you are looking for. But first of all, let's start off by talking about the income statement. The income statement basically explains this formula, which is net income is equal to revenue minus expenses. So the actual income statement is just explaining to you what is the company's net income, what is their revenue, and what kind of expenses do they have as well. And they are also explaining to you how the revenue is turning into net income for this company. So really all it's doing for you is outlining the net income, the revenue, and the expenses. And these are the main things that I look for on this document. I look at the total revenue, the gross profit, the cost of revenue, the net income, and the operating expenses. And I'm going to go ahead and explain what each one of these things are now. So first of all, total revenue is very simple. It is the total sales of a business, or all of the revenue generated from the sales of their goods and services. And then your cost of revenue is the cost incurred to obtain those sales. So let's go ahead and use a lemonade stand as an example. If you were selling lemonade, then your actual sales of lemonade, everything you were selling would turn into your total revenue, and your cost of revenue would be your actual supplies, your cups, and maybe if you had some advertising, and then your actual lemonade stand itself. So you take the total revenue and then you subtract out that cost of revenue, and that's going to give you an idea of what your gross profit is. And like I explained there, guys, gross profit is simply when you take your...
Patriot Software provides American businesses with
fundamental stock analysis might just take a look at this stock and go, okay, $100 a share, that's cheap. $1,000 a share, that's expensive. And that is why a lot of people fall into the trap of buying into penny stocks or stocks with a very low price per share. So maybe the first year is considered to be the rate, or the rate is steady or consistent over a long period of time. You don't want to see cost of revenue going through the roof and seeing total revenue not growing at the same rate. That would mean they are spending a lot more money obtaining those sales. And as a result, you're not going to see that represented in the net income because they're spending more money now. And one of the easiest ways you can look at this is just by looking at the gross profit. The gross profit, like we said, is your total revenue minus your cost of revenue. So if your cost of revenue is reasonable, then you should be seeing your gross profit increasing. So you really, all you have to do is look at the total revenue and the gross profit, and they should be growing at a very similar rate. If you're seeing total revenue growing at 20% and then your gross profit's only growing at 10%, that might tell you that your actual cost of revenue is growing faster than your total revenue. The fourth thing I look at is I take a glance over at the operating expenses, or as we said, those are the expenses unrelated to the sales of the goods or services. And all I'm looking for here is any significant jump in expenses. Was there a big jump in research and development or SG&A, or were there any non-recurring expense items? And if so, I might do a little bit more investigation on what those expense items actually were, or why there was such an increase in the expenses. And then fifth and finally, I take a look at the net income and I say, is the net income increasing? Is it flat or is it decreasing? And again, if you're looking at a growth investment, I like to see double-digit growth of net income, double-digit growth of gross profit, and double-digit growth of the total revenue. And ideally, you want to see the actual cost of revenue growing at a similar rate or a slower rate. But that is basically what I'm looking for with the income statement. I'm looking at the net income, the revenue, and expenses. I want to make sure the expenses are not growing faster than the revenue, and I want to make sure the cost of revenue is reasonable. In this video, we're going to talk about the second key financial document, which is the balance sheet. And the balance sheet is simply a comparison of the assets to the liabilities. So for those of you that watched my bonus video where I talked about my net worth, that is basically what I did here. My net worth is equal to my assets minus my liabilities. So in my bonus video example, I talked about how I have cash, I have stock market investments, I have a car, and those are all assets. And as far as the liabilities go, I talked about my car loan as well as the small amount of credit card debt that I have that I'm using to build credit over time. And you guys can check out that video if you want more details on my actual net worth and how that works. But the best way to visualize the company balance sheet is to think about, what if this was my balance sheet? What if these were my assets and my liabilities? Would I be in good financial health or in poor financial health? And that's what I want you guys to keep in the back of your mind when you're looking at the balance sheet of a company. Would this be a good balance sheet for you if you were this company? So first of all, let's go ahead and define what an asset is. An asset is an economic resource. Maybe it's a building, maybe it's just cash, but it's something that is an economic resource. Now, some assets depreciate with time, and there are assets that depreciate. For example, my car is technically an asset, but it's not going to increase in value with time. It's going to decrease. So my vehicle is a depreciating asset. And then a liability is a financial debt or an obligation. So for my example, my car loan is a financial debt and it falls under a liability. So it's basically assets versus the company's debt. Now, as far as assets go, we have current assets and long-term assets. And current assets are cash or assets that are readily convertible into cash within the next year. And then as far as liabilities go, you have current liabilities and long-term debt. Current liabilities are any liabilities or debt that is expected to be repaid within 1 year, and long-term debt is being paid back over 1 year. So for me, my current liabilities would be my credit card debt that I'm paying back every single month. It's just $2,000 that I get interest free. And as far as my long-term debt goes, I'm paying back my car loan over the course of 5 years. And so maybe the first year is considered to be current liabilities, but the rest of that is all considered to be long-term debt. So if I wanted to, I could actually split that up between my current liabilities and my long-term debt and look at my car payments for the next 12 months would be under current liabilities because I'm paying that back within 1 year. And then the cash and cash equivalents is any liquid assets the company has. So for me, my actual cash savings would fall under the cash and equivalent section of the balance sheet. And then finally, we have to talk about stockholders' equity, which is the equity stake a shareholder has in the company, or the equity applicable to shareholders, which would be you if you're an investor in this company. So once you understand what this is, you look at the assets versus the liabilities. What exactly are you looking for with the balance sheet? The first thing I look at is very simple. Do total assets exceed total liabilities? If I was in a position where I had $50,000 of assets and $100,000 of liabilities, am I in good financial health or poor financial health? And if you're looking at a company where the liabilities exceed the assets, the total liabilities versus total assets, that's not a very good position to be in. The second thing I look at is the short-term debt coverage and the long-term debt coverage. Now, you can do this in two different ways. You could start by looking at the current assets and comparing it to current liabilities or the long-term debt, or as an even stricter test, you can look at the cash and cash equivalents and compare that to the current liabilities and long-term debt. And later on in this series, we're going to talk about a couple of ratios that actually calculate this for you. So again, you don't have to actually sit down and do this on paper. But what you're looking to do is see whether the company has the ability to pay back their short-term debt and their long-term debt. So one of the very simple things that I do looking at the current assets and current liabilities is I make sure that the current assets exceed current liabilities, because if your current assets, your cash or things that are readily convertible to cash in 1 year, do not cover your debts expected to be paid in 1 year, there might be a deficit there. And that is not something you would like to see on a balance sheet for a company or on your own personal balance sheet. So third of all, the next thing
This entrepreneur
are growing or shrinking. And obviously, if you're investing in a growing company, a growth stock, you want to see consistent growth of assets. And if it's a growth stock, I like to see double-digit growth of assets year over year. But more importantly as well, we have to look at whether or not the liabilities are growing. And if liabilities are growing faster than assets, that might not be a good sign for this company. So ideally, the liability growth rate is going to be equal to or less than the asset growth rate, but this is oftentimes not the case. You just want to make sure that it's not completely out of control where you're seeing 10% growth of assets with 50% growth of liabilities. That is not something you would want to see. You want to see similar growth there. Or if you saw no growth of assets and growth of liabilities, that means that that company is increasing their debt without increasing their assets. If you were in a position where you had the same amount of assets, the same amount of cash, and it was not growing, and you decided to go out there and buy a motorcycle and a camper and increase your liabilities and your short-term and long-term debt, would that be a very wise financial decision? That's the question you have to ask yourself. And if a company has no growth of assets, but they have growth of liabilities, it's the same exact thing as that. The fifth thing I look at is the type of debt this company has. Is most of their debt short-term debt that has to be paid back within 1 year? Or is most of this company's debt long-term? And again, you want to make sure, looking at the coverage ratio, whether or not the company has the ability to pay back both the short-term and the long-term debt. Number 6, you're going to look at the actual cash and cash equivalents to determine whether or not this company is a cash cow. Is this company sitting on a lot of cash? Maybe they're planning on some kind of acquisition or expansion, or is this company burdened with debt and they have very little cash? And again, think about this in terms of you. What if you were in a position where you had nothing but assets, you didn't have any cash, and you had a lot of liabilities? If all you had was investments in the stock market, and maybe you had your car and some other assets, and you had no cash, and you had both short-term and long-term debt, you know you have to free up some of those assets, and that might not be a great position to be in. It's always good to see a company having a comfortable cash cushion, and I always like investing in companies that are cash cows, because that means they have the ability to pay back their debts, and maybe they're a company that has enough cash to pay back their short-term and long-term debt. That would be fantastic. But on the other hand, you do want to make sure the company is not being inefficient and not borrowing in the right ways, because you do want to see a healthy amount of debt with a company. And so you kind of have to find the in-between there as far as having too much debt versus too little debt, because if they have too little debt, they might be operating inefficiently and not taking advantage of the ability to borrow money to grow at a faster rate. And then finally, I look at stockholders' equity. I want to see double-digit growth with stockholders' equity year over year if this is a growth stock, because that is the equity that is applicable to you. That is your equity stake in this company. And you're going to want to make sure you're seeing consistent growth of stockholders' equity if this company has a healthy balance sheet. I'm going to wrap up and talk about the final key financial document, which is the cash flow statement. In the last 2 videos, we talked about the balance sheet and the income statement, and now we're going to talk about the cash flow statement. The cash flow statement very simply shows you the movement of cash within a company through 3 different avenues, and those are through operations, through investing, and through financing. Essentially, what you're looking to determine when looking at the cash flow statement is cash flowing into this company or is cash flowing out of this company, and you're looking at both the inflows and the outflows. Now, inflows are going to be cash coming in or receipts, for example, if this was your small business, and then outflows would be any payments that you are making. So first of all, let's talk about the 3 avenues of the cash flow statement. Operations is the most important part, and it's mostly what I focus on when I'm looking at the cash flow statement, and that is the cash generated from the sales of the goods and services. The investing side of the cash flow statement shows any gains or losses from their investments. And then the financing side shows any inflows or outflows from financing activities. So one example of an outflow would be a dividend payment to shareholders, and an example of a financing inflow would be if they issued bonds to raise capital. So I really don't pay much of any attention to the investing and financing side of the cash flow statement. What I'm most concerned with is the actual cash flow from operations. Now, if you guys want to take this a step further and really go in depth and look at the investing and financing side of the cash flow statement, I would encourage you to do so. But personally, I focus on the operations side of the cash flow statement, as that is the actual sales of the goods and services. That is what I am most concerned with when I am looking at a company's cash flow statement and interpreting the fundamentals. So the only thing that I really look at with the cash flow statement is the free cash flow from operations. And I basically want to see, is the free cash flow from operations increasing? Are they generating more cash from the ongoing sales of their goods and services? And again, like I said, guys, I really don't pay much attention to the investing and financing side, because this is a much smaller piece of this company. And that requires a little bit more skill as far as interpreting those numbers, because they typically fluctuate all over the place. So I like to keep it simple, and I'd stick to the cash flow from operations. That is the number that makes sense to me. In this video, we're going to talk about some key financial ratios that you may decide to add to your fundamental analysis strategy. Now, we're going to talk about 7 different ratios here. And the thing is, guys, there are so many different things you can look at. with fundamental stock analysis, you can really drive yourself crazy. And we've covered a lot of things, and we've talked about the best case scenarios of what it is that you are looking for. And I just want to let you guys know you're never going to find an investment that meets all of your criteria. If you go through this and you write down all of the things I'm looking for on a fundamental level for a stock, and you go through and you analyze stocks, you can analyze stocks until the cows come home, and you probably will never find a company that meets all of these specific requirements. So instead, what you're doing is you're looking through these and trying to find the best possible option, and maybe you're willing to have some leeway on certain things. And you don't have to use all of these ratios. I just want to explain to you what these tools are and what they allow you to do. And a lot of these things actually calculate some of the stuff we've talked about earlier on for you. So it's an easier way to compare these things. But we're going to talk about the financial ratios. First of all, the liquidity ratios, which is the current ratio, the quick ratio, and the cash ratio. All of these ratios show you the ability this company has to pay back debt. And then we have the margin ratios, the gross margin, the operating margin, and the profit margin, and then the after-tax ROE, or return on equity. So first of all, let's go ahead and talk about the current ratio. The current ratio shows you the coverage current assets have on current liabilities. This is something that I usually calculate myself, but if you want to, you can just go over to the financial ratios and take a look at the current ratio. So if you had a current ratio of 100%, that means that the current assets have complete coverage of current liabilities. So the cash and assets that are readily convertible into cash in 1 year have complete coverage of any short-term debt that is being paid back within that year. So what I always like to see is a current ratio of above 100%. That means they have coverage of their short-term liabilities. Now, the quick ratio is going to show you how the convertible assets have coverage of current liabilities. And honestly, guys, I don't really rely on the quick ratio at all. I pretty much look at just the current ratio and the cash ratio. And as I'm sure you guys can imagine, the cash ratio shows you how much coverage cash and cash equivalents have on current liabilities or short-term debt. So ideally, you'd find a company with 100% cash ratio, which means they have enough cash and equivalents to pay back all of their short-term debt. But again, that's in a perfect world, and you're probably not going to find that with an investment. Now, moving on, let's talk about the margin ratios. So the growth.
Since 1998, OnlineLabels.com.
Is the money a company has before paying any operating expenses and financing costs. Now, the operating margin is a comparison between the operating income and the sales revenue. And this is essentially how much a company makes before paying interest and taxes on each dollar of sales. And the profit margin, I think, is the most important one. It shows you how much the company is earning on each dollar of sales. And then the after-tax ROE shows you the post-tax profit a company generates with the money invested from shareholders. So what am I looking for when I'm analyzing these numbers? Number one, I want to see a current ratio between 120 to 200%. This means the company has good coverage of their short-term debt, and current assets have greater coverage than current liabilities. And if they had 200% coverage, that means that the current assets are double what the current liabilities are. As far as the quick ratio goes, you're looking for about a 75 to 100%. And then as far as the cash ratio goes, 50 to 100% is reasonable. But you don't want to see the cash ratio climbing too high, because that means that that company might not be taking on enough liabilities. They might be being too conservative, and that may be hindering their growth. You want to see a company utilizing financing avenues and taking on a healthy amount of debt. But a cash ratio of 100% would mean that their cash and cash equivalents have complete coverage of their current liabilities or short-term debt. Now, as far as the margins go, gross margin, you typically want to see about 25% or more. Operating margin, again, about 25% plus. The profit margin of 20% plus is great, and a return on equity of 15% is fantastic as well. But I just want to remind you guys that all of these figures here, 4 through 8, as far as the margin and return on equity goes, it's very sector and industry dependent. You're going to find that each sector and industry, just like with the PE ratio, has different levels of normality, or what you should expect as a return on equity, or as far as profit margins and gross margin and margin in general goes. The best way to do this is to take a look at the industry average overall and look at some of the other companies and compare the return on equity and the margins of one company to another company to determine whether or not this company has better margins and return on equity. But generally speaking, these would be good numbers to look for. But again, it's going to be very hard to find an investment that meets all of this criteria here. We have reached our final video in this series here, and what we are going to do is go through my final checklist of all of the items I'm looking for in a perfect world. And again, guys, remember, you will likely never find an investment that's going to meet all 12 of these things here, but this is what I'm looking for in an ideal world. And what we do is we look for the best possible investment looking at the fundamentals. But this is what I'm looking for. Number one, we talked about the PE ratio, the PEG, and the forward PE. And I'm looking for a reasonable ratio across all of these figures here to make sure that this stock is not likely overvalued or all of that future growth is priced into today's number. Number two, I look at the dividend coverage ratio. If this is a dividend stock, I make sure the company can actually afford to pay this dividend. And I also make sure the company is not being greedy and retaining too much of the earnings for themselves. Number three, I look at the revenue growth. I want to see that revenue is growing faster than the cost of revenue, or at the very least, they are keeping up with each other, and revenue growth is equal to the growth of the cost of revenue. Number four, I want to see gross profit is increasing, especially if this is a growth stock. I want to see double-digit growth of the gross profit year over year. Number five, I want to look at the short-term and the long-term coverage of debt on the balance sheet, looking at assets and liabilities. Number six, I look at the growth rate of total assets and total liabilities. I want to see if assets are growing faster than liabilities. And I also look at the current assets versus the current liabilities to see if the short-term liabilities or short-term debt are growing faster than the current assets. Number seven, I look at the cash flow from operations, and I also look at the cash and cash equivalents growth rate on the balance sheet to determine whether or not this company is deemed a cash cow. Number eight, I look at stockholders' equity. I want to see a consistent growth rate of stockholders' equity, and 10% or double-digit growth is fantastic. Number nine, I look at the cash flow from operations growth rate to see if they have more cash flow from operations coming in. And again, that will be indicated looking at the balance sheet, looking at the cash and cash equivalents. Number 10, I want to see a current ratio of above 120%. That means they have good short-term debt coverage. Their current liabilities do not exceed their current assets. Number 11, I want to see margins in general above 20% for a growth investment. And I also pay attention to the trend. I look at the last couple of years and I see, are margins consistent? Are margins growing, or are margins declining? And number 12, I want to see a return on equity above 15%. And once again, what is the trend with this? Is return on equity growing, consistent, or shrinking?
Did you know the government?
So I played this video because if you are, when you go to get your own, you're looking to try to get business loans, this is what the lenders are looking at as well. And so that video is very useful in that you could determine whether or not you would get funding for your company. So when you have someone putting your financial statements together, that you can understand what a lender is looking at as well. So that's the reason I really want. So it's definitely useful for you to determine whether or not you want to invest in a company or trade that company. And it's useful for you if you're going after any type of business loans. And so I wanted to do that. All right. Now so each morning I'm going to do something on fundamentals that has to do with the financials of the companies. And then I will do technical analysis. And then we'll talk about our trades that we're doing for today.
Hey, what's up, my friend? So welcome to the Ultimate Candlestick Pattern Trading course, right? In this course, right, you'll learn how to identify high probability trading setups so you can profit in bull and bear markets. Now, some of you might be thinking, right, I'm new to trading, right? Would this help me? I have no idea about candlestick patterns. I don't know technical analysis. Don't worry, right? Because in this course, right, I'll walk you through step by step from A to Z, right, on how to trade candlestick patterns, even if you have no trading experience. And by the end of this session, right, I can assure you that you will be able to trade candlestick patterns like a pro. Sounds good? Then let's begin. So now the first thing, right, to get started is, what is a candlestick pattern? Okay, so a candlestick pattern is essentially a method, right, of reading a price chart. It originated back in Japan, right? That's the history. And the key component, right, of a candlestick chart is that it shows you four things. It shows you the opening price, the high of the session, the low of the session, and the closing price. Okay, so when I use the term session, right, it can mean different things, right? If you're looking at candlestick charts on a daily time frame, it means the high of the day. If you're looking at candlestick charts on the 1 hour time frame, it means the high of the 1 hour session. Okay, so it can mean different things depending on the time frame you're looking at. We'll cover that in more details later. So now, how do you read a candlestick pattern, or how do you read a candlestick chart? So remember, there are only four things: the open, the high, the low, and the close. So looking at this, right, you can see that the candles are usually typically two colors, either green, red, or perhaps it can be black, white, right? Sometimes you can even change the color if you want, but generally the most common color is green and red. So when you see a green candlestick pattern, right, it means that the price has closed higher for the session. So you can see that this is the opening price, and this line over here, this is the opening price. This is the closing price. And when you see this black shadow over here, we call this a wick, right? This is the upper wick. This is the highs of the session. And this over here is the lows of the session, right? This at this point over here. So likewise, right, on the other hand, the red color bar, the bearish bar, the open is at the opposite side. The open now is on top, right, over here, the open. And the close is at the bottom. And the lows of the session is here, over here. And the highs of the session is here. So the main difference between a bearish bar and a bullish bar is that the open and close are at the opposite side. For a bullish bar, it means the price has closed higher for the session. The open is always below the close. For a bearish bar, it means that the price has closed lower for the session, and the open has to be above the close. Okay, so now let's try to understand these candlestick patterns in more depth. So first thing, right, you'll notice that is that candlestick patterns, there are two main components to it, right? One is what we call the body. This portion here is the body, right? This green area. And this black shadow thing is what we call the wick, right? So the body pretty much tells you, right, who's in control. So in this case, you can see that the buyers, the opening price is over here, and the buyers push price up all the way up higher, and finally closing at this highs of the session. However, you can't neglect this shadow as well, because what it's telling you is that there is price rejection. There is, rejection of higher prices. Because if you think about this, right, this was once the highs of the session. So what this tells you is that at one point in time, the sellers actually pushed the price from this highs down lower, right, until the price closed over here, right, until it closed over here. So if you think about this, right, this is actually a form of price rejection, right, rejection of higher prices. So there are two components to a candlestick pattern, the body and the wick. The third thing that I want you to know is this, right? What is the size of the body relative to the wick? Because you can see over here again, you have just the wick and the body, but this time around, the message is completely different, right? If you look at this candlestick pattern over here, it shows that yes, the price did close higher. The price opened here at this level, and it closed over here, right? This is the close, this is the open. However, if you look at the wick, notice the price rejection, because at one point in time, right, the highs of the session is over here at this point. And the only way for the price to actually close at this level is that the price, right, has to come all the way down from the highs, and then finally closing at this level. So what does this tell you? It tells you that yes, right, the buyers did push the price up slightly higher for the session, but there was an immense amount of selling pressure, a strong price rejection, right, that actually pushed the price lower during the session. So you can see that over here, this isn't a very bullish pattern. In fact, it's quite bearish. It shows you that the immense selling pressure by the sellers. Okay, so I also want you to pay attention to actually these three things. Number one is the body. Number two is the wick. And number three is the body relative to the wick, right? The size of the body relative to the wick. Usually, if the wick is much longer than the body, it's a sign of price rejection. Okay, so this is how you read candlestick patterns. Just three components: the body, the wick, and the body relative to the wick. So moving on, right, let's look at a few variations, right, to candlestick patterns. So the first one, I think, is something that you are probably, familiar with. The price actually opened here, open, then it closed. This is the highs. This is the lows of the session. This is a close, right? If I call it C. Then in terms of the meaning behind it, you can see it's quite straightforward. The price opened near the lows. It tried to come down lower, got rejected. Then it finally closed near the highs. At one point in time, it was actually at this level over here, meaning the buyers were at this level at one point in time, and the sellers came in, pushed price slightly lower, and finally closing near the high. So it's a sign of strength. How about this candle? You can see that the price opened here and it closed over here. So when the market just opened, right, possibly what happened is that the price came down lower, the sellers were in control, then the buyers took charge and pushed price all the way back up higher, back towards these highs. And then finally the sellers came back in and the market closed at this price level. So generally the meaning behind it is that there is, indecision in the markets. Both buyers and sellers are present, right? And the market just inched slightly up higher. So if you ask me, generally, this is what we call an indecision pattern. And if you look at this last candlestick pattern, right, the price opened here, market came down all the way down lower, sellers are in control, then the buyers took charge and reversed back and finally closing near the highs. So the meaning of this pattern is rejection of lower prices. The buyers are clearly in control. Okay, moving on, right, just the opposite variation. This one, I don't think there's much to go through, right? It's just the opposite to what we have just shared earlier. Okay, this is the selling version of it. So now let's do a quick recap, shall we? A candlestick chart, right, shows you who's in control. All right. Remember, I said pay attention to the body, the wick, and the body relative to the wick. That is important as well, right? Because if you can have a bullish close, but then if your wick is much longer than the body, right, it's still a sign of price rejection. Okay. So moving on, candlesticks on different time frames. So earlier, right, if you recall, I said that candlestick chart can appear on different time frames, daily, 1 hour, whatsoever. And if you look at this, right, this is a candlestick chart on the 60 minutes time frame, right, which is the 1 hour. So you can see that this means that every hour, one of this bar will be painted, right? Every hour, this bar will be painted. 1 hour, this bar is painted. 1 hour later, this bar is painted. 1 hour later, this bar is painted. So a bar is printed on the screen every 1 hour. And if you look at this one over here, this is the daily time frame. Okay, see this over here, 1D, right, means daily, right? This means that every single bar is printed after a day. Okay, so Monday there will be a bar, Tuesday there is 1 bar, Wednesday there is 1 bar, and etc. So this is how candlestick patterns, right, can form on the different time frames. So now, I want to walk you through something what we call combining candlestick patterns, because candlestick patterns, they are essentially just showing you the price of the different sessions. And if you think about this, right, this can be combined, right? For example, let me share with you, right? If you look at this, right, just imagine that, let's say this is a 1 hour candle, right? The green one is 1 hour, red one is 1 hour. So now when you combine these two candlestick patterns, this one over here, what time frame is this candle going to be? Well, 1 hour plus 1 hour, this will be a 2 hour candle. All right, and how did this 2 hour candle come about? Very simple, right? A 2 hour candle simply means, right, it identifies what's the high over the last 2 hours, what is the low over the last 2 hours, the opening price of the first hour, and the closing price, right, at the second hour. Simple. So if you look at this, right, this is essentially the open, this is the close, this is the highs, let's call it H, and this is the lows. Right, let's call it L. So you can see that where did we get the open from? We get the open from the first candle, because this is the first candle, the first hour of the 2 hours. Sorry, this is the open. So this is why we have the open over here. Now, where is the high? The high is simply the highest point between these two candles. So in this case, the highs between these two candles is pretty much the same. So this is the highs. What about the lows? The lows is essentially the lowest point between these two candles, between these two 1 hour candles. And the low is actually this over here, which got this. And where is the close? Well, the close is essentially the close of the second candle, which is this one over here. This candle closed at this price level, and that's why you got this close. So when you combine these two candles, this one plus this one, you're going to get this bearish looking price rejection on your chart. Does it make sense? Okay, let's look at some real examples. So if you look at this chart, right, this is the chart of the 1 hour time frame. Okay, just pay attention. I want you to pay attention to these two areas, right? These two candles, this one, and this one, this one. Briefly visualize in your head, right, that, hey, let's say I'm going to move to a 2 hour time frame right now. How will these patterns change? So let me give you 5 seconds to kind of, work on your visualization. 1, 2, 3, 4, 5. All right, so let's have a look. So if you saw those two patterns earlier, it pretty much is reflected like this on the 2 hour time frame. Can you see what happened? The two 1 hour candles are simply combined to form the pattern that you're seeing right now. Okay, let me just go back a little bit so you can see, right? This one over here, this one plus this one, and this one plus this one. So what happens is you get this candlestick pattern over here and this candlestick pattern over here. All right, so let's just to walk you through why is this green color? Because the second candle did close higher above the first. So if you look at it, this second candle over here, it did close higher above this one over here. So that's why you got a bullish close. Okay, and similar for this, right? This candle, it closed, right, but it didn't exceed the open of this candle, so that's why it's still red on the 2 hour time frame, as you can see over here and over here. Okay, so by now I hope you kind of understand how candlestick patterns can be combined. So this is very useful, right, when you're looking at a price chart, let's say the 1 hour time frame, and you can't make sense out of it, right? So if you want to see clearly, what you can do is go on to a 2 hour time frame, and things might be different, right? You might get a clearer view of what's happening. Similarly, if you're on a 4 hour time frame, you can't make sense out of it. Go up to the 8 hour time frame, and things might be clearer for you. Okay, so this is the so-called usefulness, right, of combining candlestick patterns and kind of just understanding what's going on the big picture. So now, how not to trade candlestick patterns, right? So now you know how to read candlestick patterns, you even know how to combine them. How do you not trade candlestick patterns? Because this is a mistake, right, that I see many new traders make. Because, as I've said, right, earlier, you recall that I say, if the candle is green, it means bullish. If the candle is red, it means bearish, right? The price is closed lower. So what traders will do is that they will look at the chart and they find a series of green candles and they go long. For example, they see over here, wow, man, the candle is green over here, bullish. Let me buy, right? It's so bullish. They go long and bam, market reverse. Similarly, right, they look at the chart. Oh, it's so bearish, right? Red candle. Brainer says, sellers are in control. I should go long. Bam, market reverse, right? Or if they look at, this green candle. Oh, rejection of lower prices. This candle, right? Let me go long. Bam, market reverse. What's going on, right? Why is that so? So I'll explain why shortly. But first, right, the message I'm trying to bring over here is that you don't want to trade candlestick patterns in isolation. What is isolation? It means, right, you don't want to trade candlestick patterns by and itself. Just because the candlestick is green, it doesn't mean you go long. Just because it's red doesn't mean you go short. That's what I mean by isolation. So don't trade candlestick patterns in this manner. Okay, so just a quick recap, right? Candlestick charts, it can be combined, right, as I've shared with you earlier. And also, you don't want to trade candlestick patterns in isolation. So now you might be wondering, okay, Rainer, so how should I trade candlestick patterns, right? So let's talk about that. So how should you trade candlestick patterns? I would like to introduce to you something what I call the TAY framework, the TAY framework, all right? So what is TAY? TAY stands for trend, right? A is area of value, and E stands for entry trigger. Okay, so when you want to trade candlestick patterns, right, remember these three things: the trend, the area of value, and the entry trigger. So now, before I can dive into this framework and this methodology, right, I need to explain to you what is entry trigger. Okay, so to do so, right, I would say candlestick patterns, right, are very useful and powerful entry trigger into a trade. So before we can go into this framework, right, let me share with you, right, five powerful candlestick patterns, right, that can serve as an entry trigger. And once we've learned that, right, we can look at this framework, right, and see how we can actually find high probability trading setups in the market. Okay, so moving on, the first candlestick pattern that I want you to know is the engulfing pattern. So the engulfing pattern, right, this is the so-called the theory behind it, right? So you can see that this green candle over here is what we call the bullish engulfing pattern. Why is that? Because if you look at it, right, the body of the green candle, which is the from here, the open and the close, it has engulfed the body of the previous candle. So this is the previous candle, let's call it number 1, and this number 2, right? You can see that the engulfing candle, bullish engulfing candle, has actually covered the entire body of the first candle. So this is why we call it the bullish engulfing pattern, because the meaning behind it is that if you look at the charts, right, first candle, sellers are in control. They open over here and they close near the lows. On the second candle, the buyers are somehow on steroids, like bum, right? They're on steroids, right? They open near the lows and they finally push price up all the way up near the highs over here. They're freaking on steroids, right? This is the open, this is the close. So this is a sign of strength, right? As it shows you that the buyers have reversed all the selling pressure and more. So this is why it's called a bullish engulfing pattern, right? Firstly, it engulfed the body of the previous candle, and it's a sign of strength as the buyers have pushed price higher and even closing above the highs of the previous candle. The other pattern is what we call the bearish engulfing pattern. It's just the opposite, right? You can see that the first candle over here is bullish, buyers are in control, open here and closing near the highs. But the next candle, sellers took charge and smashed the price lower, right? They opened near the highs as well, but they took charge and finally pushed price lower and closing near the lows over here. So this is a bearish engulfing pattern telling you that sellers are in control. Okay, so this is the first pattern that I want to share with you, the engulfing pattern, and it's very useful to identify market reversals. The next one, hammer and shooting star. Ding! All right, so let's have a look at the hammer. So the hammer is something that you might be familiar with because you saw earlier, right? The earlier examples. So the hammer is a bullish reversal because it's actually showing you price rejection in the market. In fact, it's rejection of lower prices. If you look at this, right, the price opened here, and at one point in time, right, the sellers were actually in control, pushing price lower near the lows of this session, right, near the lows of this session. And then the buyers came in, took charge. Hey, this is enough, man. I'm coming in, right? They push price all the way up higher and finally closing near the highs, right? So this is a sign of strength, right? Rejection of lower prices. So this is what a hammer means. On the other hand, right, the shooting star is just the opposite, right? It's showing you rejection of higher prices. If you look at this, right, the price opened here, buyers took charge, pushed the price up higher. But then, hey, sellers suddenly came in and pushed the price down. Maybe, they think that the price is too high. It can't go any higher. They sell, they short the market, and the market collapsed lower, finally closing near the lows. So this is a rejection of higher prices, right? These two patterns again are used, right, to help you identify market reversals. Dragonfly and the gravestone doji, right? It sounds a handful, but really the pattern is very similar to the hammer and shooting star. The only difference, right, is that now this doji simply means, right, indecision in the markets, but for dragonfly and gravestone doji, it's a sign of price rejection, because if you look at it, right, it's actually very similar to the hammer and shooting star that you've seen earlier. Right, let me just go back a little bit. Hammer, shooting star. Dragonfly doji, gravestone doji. So now let me ask you, what is the difference between the hammer and shooting star and the dragonfly and gravestone doji? If you think about this, right, the only difference is the doji doesn't have a body. There is no body, right? What it just shows you is just the price rejection. So this component over here is the rejection of lower prices. This component over here is the rejection of higher prices. So if you think about this, right, even though the price is open and closed at the same level, it doesn't mean that the market is undecided, because the market has actually tilted its head, right? Because at one point, the sellers were in control, pushing price down lower. And then the buyers came in, right, and took charge and finally pushed up all the way up higher and closing near where it opened, exact level. So this is a sign of strength, rejection of lower prices. And this one is just the opposite, right? Price opened at this level, buyers took charge, pushed the price up higher, and then sellers smashed the price down lower, closing at the same level. Okay, so this is a rejection of lower prices, rejection of higher prices. Moving on, right? Morning and evening star. Ding, 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 right? Star, let's look at the star. So this is a morning star. So you can see that this is somewhat similar to the engulfing pattern, but with a slight variation to it. First candle, sellers are in control. Open over here and closing near the lows. Second candle, which is this doji looking candle, is indecision, right? Because the market opened and closed at the same level. Because if you if you read this candlestick pattern, what it's telling you is the open and the close are at the same level. Market at one point in time, right, this was the highs of the session, and at one point in time, this is the lows of the session. So eventually, right, the highs and lows, the market actually went back to where it opened, right? So it's telling you that there is somewhat indecision in the markets. And then finally, right, the third candle price open and push up all the way up higher and finally closing near the highs. So if you look at the price action of this candlestick pattern, right, if you think about this, it's like first candle, sellers are in control, push the price lower. Second candle, buyers and sellers, they are in equilibrium, cannot decide who gets the advantage. So they pretty much close at the same level. Third candle, buyers stepped in, right, and say, hey, I'm in charge. Boom, price close near the highs. So that's the meaning behind the morning star. It's a bullish reversal pattern. And the evening star is just the opposite, right? First candle, buyers are in control, closing near the highs. Second candle, indecision, right? Can't decide whether go up or go down. So that's why they close at the same level where they open. On this candle over here, the open and close is at the same level. And third candle, morning star, right? Bears come in and push price lower, closing near the lows. So this is what we call an evening star, a bearish reversal pattern. And finally, tweezer top and bottom, right? So a tweezer top, right, is this one over here. Okay, so this is actually a tweezer bottom. So let's talk about tweezer bottom first. Tweezer bottom basically, right, it's I would say it's quite a powerful pattern because it's actually showing you, right, rejection of lower prices 2 times, right? First rejection, second rejection, right? So if you look at the price action again, price open over here. At one point in time, right, the sellers came down all the way down lower, right, and buyers stepped in, pushed price higher and closing here. Then the next candle, the price opened at this level. Sellers tried to push price lower once again, right, near the lows where it did previously over here. Couldn't exit the lows, just couldn't push price lower. Then the buyers stepped in and finally closing at the highs. So this is a sign of strength, right? Rejection of lower prices. In fact, we rejected the prices twice, right? So this is quite a strong pattern, right? It shows you 2 times the price rejection. And on the other hand, right, this is the tweezer top, right? You can see that over here, price opened over here and closed here. At one point in time, it was at the highs of this session before the sellers did push price quite a bit, finally closing near this middle of the range of the candle. Then the next candle, the price opened here and the buyers quickly took charge. Got rejected at the same level or around the same level again before the sellers come in, push the price lower and finally closing near the low. So again, 2 times the price rejection of higher prices. So this is a bearish reversal pattern. So now that you understand, right, the 5 powerful candlestick patterns, how does this fit into the tape? And on the other hand, right, this is the tweezer bottom. Basically, right, I would say it's quite a powerful pattern because it's actually showing you, right, rejection of lower prices 2 times, right? First rejection, second rejection, right? So if you look at the price action again, price open over here. At one point in time, right, the sellers came down all the way down lower, right, and buyers stepped in, pushed price higher and closing here. Then the next candle, the price opened at this level. Sellers tried to push price lower once again, right, near the lows where it did previously over here. Couldn't exit the lows, just couldn't push price lower. Then the buyers stepped in and finally closing at the highs. So this is a sign of strength, right? Rejection of lower prices. In fact, we rejected the prices twice, right? So this is quite a strong pattern, right? It shows you 2 times the price rejection. And on the other hand, right, this is the tweezer top, right? You can see that over here, price opened over here and closed here. At one point in time, it was at the highs of this session before the sellers did push price quite a bit, finally closing near this middle of the range of the candle. Then the next candle, the price opened here and the buyers quickly took charge. Got rejected at the same level or around the same level again before the sellers come in, push the price lower and finally closing near the low. So again, 2 times the price rejection of higher prices. So this is a bearish reversal pattern. So now that you understand, right, the 5 powerful candlestick patterns, how does this fit into the TAY framework? Right, remember the TAY, right? Trend, area of value, and the entry trigger. So now we have already settled the entry trigger portion because the reversal patterns that you have seen earlier, those are entry triggers that you can use to enter the trade. But before you trade it, right? Remember we said, right, don't trade it in isolation. Right? This means that we have to use other factors, right? Other market conditions, right? To look for before we wait for our entry trigger. And the conditions that we look for is the TAY framework, the trend and area of value. And finally, the entry trigger. So firstly, right, the trend. So what we are looking for is that if the price is above the 200 MA, we will have a long bias. This means that we want to be a buyer in this market condition. If the price is below the 200 MA, then we will have a short bias. This means that we will only be looking to short, right? So understand that when I define the trend, right, it doesn't mean that just because the price is above the 200 period moving average, it doesn't mean you go long immediately. No, right? This is just to give you a bias, a permission that, hey, now it's time to be buying. Now it's time to be looking for buying opportunities, okay? So now that we have defined the trend, the second thing we want to look for is area of value, right? You want to trade from an area of value. When you go to a supermarket, you don't be buying apples, right, when you're selling 3 apples for $30. You want to be buying apples at 3 for $1, 3 for $2, right? You're getting value out of it. And it's the same for trading, right? When you want to buy, trade from an area of value. So an area of value could be stuff like support and resistance, moving average, trend line, channels, etc., etc. So I'm just going to give you a few examples over here, area of value. And the third thing is where we look for the entry trigger to enter the trade. Like, for example, the candlestick patterns you've seen earlier, engulfing pattern, tweezer tops and bottoms, and etc. Okay, so now using this framework, we can then formulate trading strategies, right, to profit in bull and bear markets. So remember the first thing we're looking for, the trend, right? If it's in an uptrend, we will only look to buy, and we'll buy at either area of support, moving average, or upward trend line. And then we'll look for an entry trigger, right? The entry trigger will be a bullish reversal pattern, like a hammer, a bullish engulfing pattern, right? A dragonfly doji, and etc. Does it make sense? Okay, so now let's have a look at a few examples to kind of bring in this concept together, bring all these concepts together. Example 1. So you can see over here, right? I don't have the 200 MA on the chart, right? But needless to say, the trend is down, right? Because you can see that the market is moving from up to down, so it's a downtrend. Then we saw that the price came into this area of resistance, right? Where the price got rejected once, twice, and a third time. And the third time over here, you got this entry trigger. So number 1, you look, right? You have the trend. What is the trend? The trend is down. Number 2, do you have the area of value? Yes, you do, right? This is the area of value, right? At resistance, right? And number 3, do you have your entry trigger? Let's call it E, entry trigger. Yes, you do have, right? This is a shooting star, rejection of higher prices. So can you see that now you're not trading candlestick patterns in isolation? Now you're trading candlestick patterns in the context of the market, meaning you're trading candlestick patterns, right? Based on, market structure, based on the trend. This actually increased the probability of your trade working out. So you can see that over here, right? Shooting star occurred at resistance in a downtrend, okay? And the market did continue to slide lower. So one thing to point out is that the examples I showed you, right, are all pretty much winning trades. But in reality, right, you won't get all winning trades. You will probably get, a 50% winners, 50% losers, okay? The reason why I share winning trades is because it's easier to illustrate the concept. But again, those charts, or rather the charts you're seeing right now, these are cherry pick, I admit, right, to illustrate the point I'm trying to make across. But in the real world of trading, right, you won't have 100% winners, somewhere along 50%, 55% winners. So this is something that you must kind of accept and embrace. Okay, so this is the first example. Second example, right, what is the trend? Number 1, what is the trend? Trend is, well, down, right, downtrend. Right, you can see that the price is coming down lower. Number 2, where is the area of value? This time around, the area of value is a moving average. This is the 50-period moving average, right? It's acting as a dynamic resistance. Number 3, what is your entry trigger? This time around, we have this bearish engulfing pattern, right? Notice this over here. Market close higher. Second candle, smash lower, closing near the low. So this is what we call a bearish engulfing pattern, right? So we have 3 things. Number 1, trend, area of value, and entry trigger. And we can go short now, having our stops above this highs somewhere here, right? And the market to see if the market can continue lower. So now you can see that, hey, we're all trading with something that that kind of makes sense, right? Based on what the market is telling you, and not just trading these patterns blindly in isolation. Example 3, all right? Look at this, right? Ask yourself again, what is the trend? Number 1, what is the trend? Well, uptrend, right? Series of higher highs and higher lows. If you can't see this, right, you just pull out your 200 MA, right? And chances are this one, the price will be above the 200 MA. So anyway, the trend is up. Second thing, area of value. Do we have an area of value to trade from? Well, seems like it, right? Because the price has been respecting the 50 MA here, 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 and here. Okay, so number 3, end trigger. Do we have an entry? Well, seems like it, right? We have a bullish engulfing pattern over here. A sign of reversal, rejection of lower prices, right? Price close higher, engulfing the first candle. Here as well, price open and then close higher above the first candle, another bullish engulfing pattern. So this is a bullish reversal pattern that you can go long, right? Another bullish reversal pattern that you can go long. And again, we're not going long just because we see a bullish reversal pattern. We go long because it's in an uptrend from an area of value, right? Let's have a look at another example. This time around, right? What is the trend? Again, what is the trend? One look, it's an uptrend. Number two, area of value. Where is it? Right? If you look at the area of value, we have this trend line support. So this time around, it's not a moving average or support, right? It's a trend line, upward trend line. So you can see that over here. In fact, if you look closely, this over here, right? You can actually plot a level over here. It's what we call a previous support that acts as resistance. This one, and on top of it, you have the confluence of a trend line. So your area of value now is there are two things, right? Let's call it times two. One is the trend line, upward trend line support, and the other one is the previous resistance and support, right? So this is a strong area of value. The third thing, what do we have? Bullish engulfing pattern, right? We have this, right? So this is your entry trigger. Again, the Tay framework is met, right? Uptrend, area of value, entry trigger, right? This is bullish engulfing. It's a bullish reversal pattern. Okay. Another example, right? I really want to hammer in this concept, right? So once you can apply it, right, I would say that you can start finding, right, much higher probability trading setups instead of just blindly trading these patterns. So again, number one, what is the trend? Well, downtrend, right? Number two, area of value. What is the area of value? This one over here, right? Resistance, previous support, acting as resistance, resistance. Okay, number three, what is the entry trigger? I think we got something called the tweezer top, right? So you can see that the price rejected the highs over here one time, and it rejected here a second time, right? And finally closing near the low. So this is a tweezer top bearish reversal pattern. Traders can look to go short, and stop loss, right? I typically set it a distance away from the highs. I don't want to set it immediately directly above the highs because sometimes the market can just spike up higher and then reverse lower, right? So usually I give it some buffer, put it somewhere here, right? If you notice, I have not talked about target profits yet because this entire course is about candlestick patterns. I don't want to go into trade management and target profits. If not, you run, right, for a few hours, right? But generally, right, if you're a swing trader, what you can do is to capture a swing, look to take profits, right, before the buying pressure comes in. So now you are looking to short. You want to take profits, right, before where buyers will step in and push price higher. So if you look at it, right, where will buyers come in, right? Buyers, chances are they will come in, right, at this area of support. So you might want to take profits, right, before this area of support. Okay, so say your stop loss is here, your entry is somewhere here, right, and your target, right, could be somewhere here before the area of support. So TP, E is for entry, and S is for stop loss, right? Stop loss, entry, target profit. So this is something like how we can go about trading this particular market, right? So this is for swing trading. For position trading, what you can do is just trail your stop loss, right? You can use a moving average, like a 20-period moving average to trail your stop loss. If the price closes above the 20 MA, you exit the trade. Or in this case, right, if the price breaks and closes above the previous candle high, you exit the trade as well. So in this case, right, the candle did this candle over here break and close above this previous candle high. So you exit somewhere here. So depending whether you're going to capture a swing or ride a trend, your trade management will differ accordingly. Okay, so but that's a video for another time, but just to give you a brief introduction to trade management and exits. Example 6, right? Let's have a look again, right? So again, the Tay framework, number one, what is the trend? Tell me. Right, the trend is down. Number two, do we have an area of value where we can trade from? It seems like the market is respecting this 50 MA, right? And then, third thing, do we have a valid entry trigger to trade from? Oh yes, we have an evening star, right? Price close higher, indecision candle, and then smash lower, reversing near the lows. So now we have the trend, downtrend, area of value 50 MA, and entry trigger is this evening star bearish reversal pattern. Okay. One final example to really hammer home, right? The concepts that you've learned today. Number one, what is the trend? Trend is downtrend. Okay. Number two, are we trading from an area of value? Yes, we are. Previous support, against resistance. Okay. Number three, do we have a valid entry trigger to go short? Hey, what is this? This looks like an evening star. All right. So evening star, right? market close higher. Second candle, somewhat of an indecision candle. And then third candle, market close lower. All right, so yes, we have all these three criteria are met. So one thing to point out, right, is that earlier, you've seen that I've shared with you the different reversal candlestick patterns. And if you notice, right, the evening star looks slightly different from what I shared earlier. What I shared earlier, if you recall, this middle candle shows a doji where the price open and close at the same level, right? Whereas this one over here, there's actually a slight body where the price did close higher slightly. And this is important because what I shared with you earlier, the so-called textbook patterns, right? There are always variations to it in the live market. So this is why it's so important to understand the candlestick patterns, not by memorizing patterns, right? But understanding, right, what each candle mean by looking at the wick, the body, and where did the body close relative to the wick. So this is why I keep hammering that point earlier, the 3-point body, the wick, and where did price close, right, for the body relative to the wick. Okay, so because in the real world of trading, you won't get these textbook examples, right? You won't get, the open and close at the exact same price level. Sometimes it's going to be a slightly higher open, sometimes it's going to be a slightly lower close and stuff like that. And you got to understand, right, the nuances and the variations that can come with it, right? Same for the, tweezer tops and bottoms. If you see earlier the tweezer tops, right, the textbook example I shared, the highs, right, were at the exact same level. But for this example, this one, the second candle, the highs actually exceeded the first candle. Again, there are always variations to it. So if you're the type of trader that, memorize the patterns, then you're going to have a really hard time because the market will not give you the exact textbook setup. It always comes, variations, slight nuances and changes along. So you have to be prepared and, really know how to read candlestick patterns. So that's why we spend some time, right, talking about reading candlestick patterns in the earlier part of the video. Okay. So with that said, let's see. Okay, we've covered this. All right, let's do a quick recap, shall we? What have we learned? So far, we have spoken about the TAY framework, right? The trend, area of value, and entry trigger, right? If you look for these three things, right, you can find high probability trading setups in bull markets and bear markets. Then we spoke about the candlestick patterns that you might want to pay attention to, the engulfing pattern, the hammer, shooting star, doji, tweezer, tops and bottoms, and morning and evening star. Okay, so now, right, that's pretty much what we have covered. So give me a moment, let me check. So yep, that's a recap. And really, if you want to learn more, okay, if you want to learn more about what I do, what I recommend is, you can go down to my website, tradingwithrainer.com. Okay, if you can't find it, this is it, right? You can go down to my website, tradingwithrainer.com.
All right. Let's see what's going on in the market. So lots of information. I hope you guys grasp some of this information and you learned something.
Thank you, Monica. Appreciate
you. I knew it was a lot, but I try to do fundamentals, little fundamentals, a little technical at the same time, especially the fundamentals, because a lot of people always ask me about grants and loans, business loans and lines of credit. And I'm like, you can only get, when they ask for your financials, they're looking for this. Those simple 4 or 5 categories that he just spoke about, in your own business, they're looking for this. So, and I usually try to tell people, like, well, I don't have no business income, because they like to not file taxes and not to include business income. And I'm like, well, how can you want somebody to give you a line of credit or a business loan or a grant if you don't show that you can make revenue, you can create sales, products and services? Like, so we just giving you money? That's like just giving you a gift. Like, what are you gonna do with it? You can't do anything with it because you don't know how to make any money. So that's why you can't get any. And so they'll say, can you get me? And I'm like, okay, do you have any cash flow flowing through your company? You have to show something. If you got a good idea, then you should have had people purchasing either those products or those services, right? At a minimum, you should have something, So that's one of the reasons that I show, I'm showing a lot of the fundamental analysis, because some people don't, some people need to grasp it. Good morning. Hey. Thank you. um, you know, they don't. Some people just don't have a grasp of that in everyday business, and when they get someone to create their financial statements, they don't even really know how to read them. And so, if you understand these videos that I'm showing, then you would know how to approach your own business as well, especially the fundamentals, which is analyzing your financial statements, the balance sheet, the income statement, and the cash flow. You would get an understanding of that part. Um, let's see. Let me see what the chat talking about. I think somebody talking about himself. After looking at charts for a long time, I came to conclusion God is higher low and lower high. Every new candle rarely touches the previous high or previous low. It does that after a long run. I would love to come and split some game when you have a free for all stream. Some might hear something and be able to add participate. Sure, with on Wednesday or one of the mornings, sure, because I'm just sharing information and I'm learning as I go. So I pick videos that I'm in the moment and wanting to learn from. So I just saw fit to share it on live, and then I'll pay attention to the videos as well as I grasp the information. I'm nowhere near an expert. I'm just learning as I go and just start as I'm in my beginner stages. There's someone else out there may be the same, and they may catch on to some things that is relevant to them when they're trading, and then particularly when they're setting up their own companies. So it's cool. You can share a screen. Let me know when you're ready. You can do it tomorrow on our Wednesday show if you would like, and we could commentate. The only thing I don't want is like when folks come on to share. Like I don't like absolute statements, and so some the charts will give its information. Everyone has an opinion, but that we respect each other's opinion. Because everybody's going to develop their own methodology and it's educational. So, you know, someone may be able to learn from your method, someone may be able to learn from someone else's method. As long as we begin to get the information out, more people begin to understand it, and we have more dialogue across our little social circle that we are able to benefit and increase our portfolio. That's all I'm concerned with. You know, there's more than one way. Labor shouldn't be the only way that you gain revenue, right? You should be able to benefit from all aspects. So that's why I'm here, just sharing. And besides, I need to get myself up in the mornings. So this is my way of doing it. Yeah. You got anything you want to add, Jermaine? I have to do some work today, so I can't be playing with them until no 10 o'clock. Not today.
No, I'm cool. I got to go to work anyway, so I'm just sitting here listening, just gathering information as you provide it. I appreciate it. Though, give thanks.
Anything that stood out to you on fundamentals or the chart patterns?
The profit and the P&E, on how they determine the P&E.
Yeah.
Like with the TTM and how they divide it and stuff like that. That I want to focus more on that, so I have an understanding of that. Even though it's already done for us,
Right.
I would still have to have knowledge of it.
Right. Because I will the more I listen to, I'll choose the fundamental videos, and I'll repeat them 2 or 3 times, and then I'll find someone else, and then I'll find, okay, so if everybody's saying the same thing, okay, I need to make sure I pay attention at this, this particular number, this range, to get a good grasp of when, if I look at FinViz, I can scan the chart, boom, 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 and I'm like, okay, this is a use case value. All right, now let me focus on the technical side, because I know I picked a company that's, in kind of good standing, so to speak, right? And then you could kind of go to the charts and do your thing from there. I absolutely love when Brother African Emporium showed me I was having trouble exiting, right? Either I was exiting too early or I was missing the exit. And he pointed out the tweezer tops and the tweezer bottoms. Oh man, talk about that! That helped me out a lot, right? Because you could clearly see the reversals. You could see it here, you know, you can see it there, you can see it there, you know. So I was like, oh yeah. And even though sometimes I may come out too early on a, on an uptrend, but at least I have a good exit strategy, right? Based on that candlestick, that good confirmation. Let me say that, based on that candlestick pattern. Um, so yeah, that's cool. I'm with it. So I don't really. Let's see. I got to get out and do some work, so I can't. I won't stay. Since let me show. Yeah. So I'll end it right here because that was a lot. That was what almost 2 hours. Yeah.
Yeah.
And that's maybe something some folks want to go back and run through since both of them runs back to back. So,
but how do you get on YouTube though? Is this on YouTube also?
Yes, it's on Brother Garfield podcast, our Dagger Squad.
Brother Garfield on his podcast. Okay.
Yeah, you can see it right there.
So how do like people be talking on the podcast?
You're talking on the podcast right now.
Oh, okay, got
it. All the thing I did was I played the video, so you can hear. Yeah.
Okay, understood.
Yeah,
okay.
yeah. So you can hear it through the video. I'm dual live streaming actually dual live streaming. Let's see. I thought that I was streaming on my channel, so I gotta fix it. Trying to do a live stream on both. So I'll fix it by this evening. And I don't want to stay live anyways because I got the stream this evening at 6. So I'll probably edit 6. I'll probably do some contract stuff in the beginning. Some government contract. It's tax season. I probably talk about some taxes, that kind of thing. QuickBooks Self-Employed, that app, show some information because everybody needs to be getting ready for taxes and no need to be filing your taxes late.
I did download the app and
you did?
I registered. I just gotta pay. So they got like a code off. It's like $6.99 for like 3 months.
Oh, good. You got a good deal. And do you see you make sure that you signed in, it's picking up your mileage because sometimes they sign you out. Yeah.
Yeah, there's like they have an option like you can opt to use while the app is using it, or while you're using the app, or while you're not using the app, or always on. So I just chose always on.
Yes. Make sure.
And then I could decipher, what was work miles compared to personal miles.
Yes. You will love it. You would definitely love it. Anybody else out there, independent contractors, you get a 1099 of some sort at the end of the year. You're freelancing, you're doing little side hustles, and you want to take advantage of being a sole proprietor, get those tax deductions, lower your taxable income because you probably also have a job, you're single, you're paying too much taxes. Check it out. This is one of the best apps to use right here. It would capture that information for you. Let's see what else. I mean, there's so much. It also even allows you to send out invoices. So, you can legitimize your business, make things work for you. You just have to, a lot of the apps actually are they're adding the tax component, the invoicing integration, and I haven't seen too many accounting apps have the mileage. Our cash flow manager have the mileage. I know QuickBooks has the mileage, but I've seen independent apps with the mileage, and so that's why I favorite the QuickBooks. because it has the mileage component to it.
Got you.
Yeah.
Yes, that is a good feature because
Yeah.
it's always asking me.
Yeah. And so you could have your incoming expenses all come in. It's consolidating everything into your Schedule C tax portion. So even if, and you could take pictures of your receipts. So everything is right there, and you can link it to your account. And so if someone else is preparing your taxes, you can give them access to it, let them go in, get what they need, and keep it moving. Or if you were doing it yourself, you could get all the information. It's already consolidated, put it into your taxes, and boom, file your taxes on time. Too easy, you guys. So I'll talk about some of that this evening. Thanks, Jermaine, for coming on. Peace, power, and Prophet Garfield, and everybody who watched in the YouTube. Maintain a pretty good crowd this morning. Y'all must have been real interesting. So peace, guys. Y'all have a good one.
Peace. Thank you.
It's on the screen that I can see so that it can have a chart up. Yahoo Finance. Dun, 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 dun. Let's see.
Brother Chris thinks the stock gonna go up today.
Who? Which one?
Brother Chris.
Which stock?
I'm assuming SPY. Yeah, I think he said just the market probably going up.
Shoot, it's been going